Yes, good evening. And we are going to discuss on the financial statements of a manufacturing account. This is a CASNEP exam. And the question that we will be discussing is a question which was set in April 2023 under the statement of financial statements for the manufacturing account by CASNEP. So the question reads, we are told that Peter Mwangi and Arois Onyango began trading in Pengo Manufacturers on 1st January 2022. The foreign trial balance was extracted from the books of the partnership as at that 1st December 2022. You are given the capital, then we have the drawings, you are given trade receivable and trade payables, bank balance, plant and machinery at cost, raw tools at cost. We have sales, motor vehicle at cost, raw material purchased, direct factory wages, electricity expense, indirect factory wages. Also, you are given plant and machinery repairs, motor vehicle running expenses, rent and insurance, administrative staff salaries, administrative expenses. We have sales and distribution expenses. Other than that, additional information, you are told that inventory as at we have inventory as at 31st December 2022 were as follows. Being that we are talking about a manufacturing company, when it comes to the inventory, we have what we call inventory of raw material, work in progress, and finished goods. Then number two, we are told that as at that 1st December 2022, accrued electricity expenses amounted to shillings 10.4 million, while prepaid rent and insurance amounted to shillings 7.84 million. Then from there, number three, we are told that the following expenses are to be apportioned between the factory and administration in the ratios indicated. One, we have the motor vehicle running expenses, electricity expenses, rent and insurance, plant and machinery repairs, motor vehicle depreciation. Number four, we are told that the estimated useful life of the plant and machinery is 10 years, while that of the motor vehicle is 4 years. The partnership uses the straight-line method to provide for depreciation on motor vehicles and plant and machinery. Number five, the partners share profit and losses equally. Allowance for the doubtful debt is to be made at the rate of 5% of the accounts receivable as at 31st December 2022. Then number seven, you are told that manufactured goods were transferred from the factory to the warehouse at shillings what? 85,600,000. And number eight, raw tools as at that 1st December 2022 were valued at shillings 13.6 million. Required manufacturing and statement of profit or loss for the year ended at 1st December 2022. Statement of financial position as at 31st December 2022. So that is the requirement. So we are going to do our presentation very fast. So therefore, being a manufacturing account, we are going to start by the manufacturing what? We start with the manufacturing account. And this manufacturing account is going to have the opening inventory of raw materials. So our shillings are given in 1,000. We are going to have the debit side, and also we have the credit side. Therefore, once we have this, we are going to start with what? Opening inventory. We have the opening inventory of what? Of raw materials. Opening inventory of raw materials. And how much are we given? Since it is when we have started this business, therefore the only thing that we can have is purchases and crossing inventory. So the opening inventory, we have nothing in this case. So therefore we go to purchases of the raw materials, purchases of raw materials, purchases of raw materials. And if you look at the purchases of raw materials, we are given an amount of how much? The purchases of raw materials, let us look at the purchases of raw material. We are given an amount of 44,000. Then from there, other than the purchases of raw materials, we have the closing inventory. Closing inventory of raw materials. Closing inventory of raw materials. Remember, anytime you start a business with purchases. And then from there, so therefore, you can have the closing stock at the end of the year. You are going to have something that is remaining in the stock. And how much was remaining in the stock? We have the information in additional information number 1. So we are told the raw materials was an amount of 15,200. 15,200, that is what we have. Then from there, we are going to have what we call the cost of raw materials used. So let us get the cost of raw materials. Raw materials used. The cost of raw materials used. We are going to have an amount of how much? In this case, we will have an amount of how much? The cost of raw materials. So let us see. Here we have an amount of 44. We have an amount of 44,000. Then from there, we less 15,200. Therefore, we are going to have the cost of raw material. The cost of raw materials used. We will have an amount of 28. We have an amount from the calculator. An amount of 28,800. Then from there, we look at other direct expenses. Other direct expenses, we have what we call, from our question, we have the direct factory wages. So we are going to add the direct factory wages. We have direct factory wages, and we are given an amount of how much from the trial balance. From the trial balance, we have an amount of 4,800. We have an amount of 4,800. Then from there, we are going to get what we call the prime cost. Prime cost. So in this case, our prime cost will be how much? Let us get our prime cost. Our prime cost is going to be, we take 28,800 plus what? Plus 4,800, and our prime cost will be 69,600. We are going to have an amount of 69,600. Once we have the 69,600, then we go to what? We go to the factory overheads. We need the factory overheads. Let us have the factory overheads. And for the case of the factory overheads, what do we have? We can start from the additional information, and the additional information that we can start with is the additional information number 3. Additional information number 3, we are told that the following expenses are to be apportioned between the factory and administration in the ratio indicated. In the ratios indicated. The first one we have there, motor vehicle running expenses. So we have the motor vehicle running what? Motor vehicle running expenses. And for the motor vehicle running expenses, what do we have? We go to the trial balance and we see how much we have. When we go to the trial balance, the motor vehicle is showing an amount of how much? 19,200. We have an amount of 19,200. 19,200. Out of 19,200, we are told that a half will come to the factory overhead. So therefore, a half will be how much? A half of 19,200 divided by 2. We are going to get 9.6 million. Will go to what? Will go to the factory. Then the remaining half will go to the administration. It will be an administration expense. So other than that, the next item they are talking about is electricity expense. So we have the electricity, 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 electricity what? Expenses. Electricity expenses. And when we talk about the electricity expenses, what are we told? We are told about the electricity expense that two-third will go to the factory. So first we need to adjust the electricity expense. Electricity expense, we start from the trial balance. We have an electricity expense of 13,600. We have 13,600. This is what we have. Then when we go to note number 2, additional information number 2, we are told that additional information number 2, this is what we are told. We are told that as at 31st December 2022, accrued electricity expense amounted to shillings what? Amounted to shillings 10,400,000. So we have 10,400,000, and therefore in this case that is what was being owed. So if you have an accrued electricity at the end of the year, you need to adjust, meaning that is an expense for that year that have not been yet settled. So it is going to increase our expense for the year. So you add 10,400, and then therefore from there we are told that out of these, 2/3 will come to the factory overhead. 2/3 we are going to take it to the factory overhead. So 2/3 of that is going to be how much? When we take the 2/3 of these, let us first get the total. 13,600 plus what? Plus 10,400. Then we are getting 24,000. 24,000 to that. To that will be an amount of how much? An amount of 16,000. 16,000 will be taken to the factory overhead. Other than that, we go to note 3 again. We have rent and insurance. We have rent and insurance. Rent and insurance. So how much do we have as the rent and insurance? From the trial balance, I can see we have an amount of 18,880. Then from there, we are told that 18,880, while prepaid rent and insurance amounted to shillings what? Amounted to shillings 7.84 million. So this 7.84 million is prepaid at the end of the year, meaning that they have overpaid, and that overpayment that they have done, that will be an expense for the next financial year. And what we need is an expense for this current year. So therefore we are going to subtract that overpayment of how much? Prepayment of, we are told it's a prepayment of 7.84 million. So we subtract that, and the portion that we are taking is a portion of which one? We are taking a portion of 3/4. We are told that 3/4 will be taken here. So therefore, how much are we going to have in this case? In this case, let us adjust. It is 18. We have 18,880. Then we subtract 78,40. Then from there, we are having an amount of 11,040 times 3 out of 4. 3 out of 4, we are going to get 8,280. We have 8,280. That is the amount that we are having in this case. It is the amount that we are having in this case. After the rent and insurance, we have the plant and machinery repairs. Plant and machinery repairs. Plant and machinery repairs. And let us go to the plant and machinery repairs. How much are we given for the plant and machinery repairs in the trial balance? Plant and machinery repairs. we are given an amount of 10,880. 10,880. We have 10,880. And how do we appropriate or how do we apportion these? We are told that the factory will take 4 out of 5. So therefore, we are going to take 10,880, then we multiply by 4 out of what? Out of 5, and therefore here it will be 87,040. Sorry, 87,004. 87,004. Other than that, the final one, we have the motor vehicle depreciation. The next one is depreciation. We have the depreciation motor vehicle. Motor vehicle. We have depreciation motor vehicle. And for the depreciation motor vehicle, what are we told about this? What are we told? When we go to note number 4, we are told that the estimated useful life of plant and machinery is 10 years, while that of the motor vehicle is 4 years. While that of the motor vehicle is 4 years, then from there, they continue to tell us that the partnership uses the straight-line method to provide for the depreciation on motor vehicle and plant and what? Plant and machinery. So let us go to the cost of the motor vehicle. The cost of the motor vehicle was 33,600. We have 33,600. Then from 33,600, we are going to divide by what? We have 33,600. We divide by 4 for us to get the depreciation. After we get the depreciation, this depreciation is going to be shared between the factory and administration 50-50. So also you are going to divide by 2. So therefore, how much are you getting? 33,600. Then you divide by 4. Then you divide by 2. We will get 4,200. 4,200. Then from there, we are done with note number 3. For the note number 3, we have adjusted that. Once we have adjusted that, we go to note number 4. Note number 4, we have also adjusted that. Then we go to note number, so we go back to the trial balance and look at the other items which are going to affect what? We look at other items which in this case are going to affect our manufacturing account. Other items which will affect our manufacturing account, other items which are going to affect our manufacturing account. We want to look at other items which will be affecting our manufacturing account. Other items which will be affecting our manufacturing account. So we go to the trial balance. We go to the trial balance. So when we go to the trial balance, we start from the top. The top, they are talking about the capital account. Also, we have the drawings. Other than the drawings, we have trade and receivable, bank, balance at bank, plant and machinery. Then we have the roosters. The roosters, we are given the opening balance and closing balance. So therefore, let us look at the depreciation. We can get the depreciation. Depreciation of what? Depreciation of roosters. Let us see. We have the opening balance of how much? We are given an opening balance of 16,800. Then we compare with what we have at the end. At the end, note number 8, roosters, as at 1st December 2022, were valued at 13,600. 13,600, meaning the roosters have depreciated. By how much? The difference. They have lost the value. 800, 16,800 US, 13,600, and therefore we are getting 3,200. 3,200. That is what we are having. Then from there we continue with our journey. We have the sales, then we have the motor vehicle at cost, raw material purchased, direct factory wages, Then we have electricity expenses, indirect factory wages. Another item is indirect factory wages, indirect factory wages. And under indirect factory wages, we have how much? 16,000. Sorry for that. We have 16,000. Then from there, we have plant and machinery repairs, then motor vehicle running expenses, rent and insurance, administrative staff salaries, admin expenses, sales and what? Sales and distribution. Sales and distribution. Then from there, what else? Then also, we can include what? Yeah, depreciation. We can include the depreciation of plant and what? Plant and machinery. Depreciation. So let us have the depreciation based on cost. The cost of plant and machinery is how much? Where is the plant and machinery? Plant and machinery, not repairs. We need the cost of plant and machinery. It's an amount of 57,600. Then we divide by the useful life. Useful life we were given in note number 4, which we are told is 10 years. Then which percentage are we to take here? We take the full amount. So it will be how much? This you divide by 10, you are going to get 5760. And then from there, how much do we have as the total? Can we get the total? We get the total, the cost of goods available for sale. Let us get the total. So our total will be how much? Let us accumulate. And when we accumulate, we are going to start from here. So therefore, it will be 69,600. Then we add 9,600 plus what? 16,000 plus 8280. Then we add 8704. We add 4,200. Then we add 3,200. Then we add 16,000. Then we add what? 5760. And therefore the total, we are going to have a total of how much? A total of I'm getting 141, 344. 141, 344. That is the total that I'm having. Then from there, we are going to add the opening work in progress. After getting this, we add the opening what? Opening work in progress. Opening work in progress. You can never have an opening work in progress when it is the same financial year that you have started what? You have started the business. Then from there you raise the closing. What? Work in progress. Closing work in progress. Additional information number 1. We are given the work in progress of 19,440. We have 19,440. And therefore, when we take our calculator, we are going to get the total cost of what? Total cost of production. Let us get the total cost of production, 141, 344. Then we raise 19,440. Therefore, the cost of production will be 121,904. Cost of production will be 121,904. 121,904. That will be our cost of what? Our cost of production. That is what we are going to have as our cost of production. That is what we are having as our cost of production. Then from there, once we have the cost of production, what are we told? We are told that if we go to note number 7, we are told that manufactured goods were transferred from the factory to the warehouse at what? At shillings 85,600,000 at shillings 85,600 what? 600,000. So therefore, in this case, also we are given the transfer price. We are given a transfer price of how much? We have a transfer price. We can write it at the top here. Transfer price. We are given transfer price of 85,500. So they transferred at 85,500. While the cost of production, remember this is the cost of production that we have. Cost of production. So we can either transfer at a profit or we transfer at what? At a loss. We can either transfer at a profit or we transfer at a loss. You can see the cost of production is much higher compared with what? With the transfer price. Therefore, we had a loss of how much? Loss on transfer. Loss on transfer of how much? Loss on transfer of how much? We are going to get the difference. You take 85,500, so we have 85,500, then we less 121,904, and we had a loss of 36,404. 36,404. That is a loss. Then this, whatever that we have presented up to that point that we have reached, this is what we call the manufacturing account. For the manufacturing account, you are going to have what we call the prime cost. Then once you get the prime cost, you go to the factory overheads. The prime cost consists of what? Consists of the direct materials and direct what? Direct labor. When you take the direct material and direct labor, you are going to get the prime cost. Then you go to the overheads. Then from there, the transfer price is our final answer as we have prepared what? The manufacturing what? As we have prepared what we call the manufacturing statement. Once we have prepared the manufacturing statement, remember the examiner wanted the manufacturing and statement of profit or loss. So we continue with the same. So when we continue, we are going to start with the sales or revenue, depending on how the examiner has called it. So did the examiner call it revenue or the sales? The examiner, did he or she call it revenue or sales? He called the sales. And we have a sales of 160. When we go to the trial balance, 160,600. Then from there we need what? We need the cost of sales. When we talk about the cost of sales, we have the opening what? Opening inventory. Cost of sales, we are going to start with the opening inventory. We will have the opening inventory. But now this opening inventory we are talking about is for the finished goods. Opening inventory for the finished goods. We started the business in this financial year, therefore we cannot have what? The opening inventory. Therefore, in this case, we are going, the production or the purchases are taken over or are presented by what? By the transfer price. The transfer price is going to take the part of what? The part of the purchases. For the case of the manufacturing company, here we don't have the purchases. We can either have the cost of production or what? Or the transfer price, which we are given an amount of 85,500. Then from there we raise the crossing inventory. Crossing inventory of what? Of finished goods. Again, we are given in note number 1. How much are we given? We are given an amount of 8,000. We are given an amount of 8,000. Therefore, from there, we are going to get a cost of goods of how much? Let us see. We will take the transfer price, 85,500, then minus 8,000. Then we get 77,500. This is what we have as the cost of sales. Then we get the gross profit of how much? Gross profit. Our gross profit will be how much? You are going to take 160, 600. Then we subtract 77,500. Therefore, we are getting 83,100. 83,100. 83,100. That is what? That is the gross profit. Gross profit. Once we get the gross profit, do we have other incomes? We look at whether we have other incomes. Other incomes we don't have, so we go direct to expenses. Let us present the expenses, and if you want to make your work easier, you start with those expenses which were apportioned. And those expenses which were apportioned, they are here. The expenses which were apportioned are here. The first one, we start with the motor vehicle running expenses. So we have the motor vehicle running expenses. Motor vehicle running expenses, we had an amount of 19,200. Then again, here you take a half. So a half of this will give us how much? The same amount, which is 9,600. Then from there we had electricity expense. Electricity expenses, it was 13,600 plus what? 10,400. Then they took 2/3. The factory took 2/3. So here we are going to take what? A third. So it will be how much? It is 13,600 plus 10,400, which is 24 times 1/3, and therefore ours will be 8,000. Then from there we go to rent and insurance. We have rent and insurance. Rent and insurance, we had an amount of how much? An amount of 18,880. Then we subtracted 7,840, and our ratio here will be, here we took 3/4, so our ratio here will be 1/4. So therefore, how much are we going to get? It will be 18,880. Then we subtract 7,840. Then from there we multiply by 1/4. We are going to get 2760. Other than that, we have the plant and what? The next one is plant and machinery repairs. Plant and machinery. Plant and machinery repairs. Plant and machinery repairs, which will be how much? The plant and machinery, it is 10,880. Then we multiply by what? This is 4/5. Therefore, here will be 1/5. So therefore, how much are we getting in this case? It is 10,880. We multiply by 1/5, and therefore we are getting 2176. 2176. That is what we have. That is what we have. And all these expenses, remember, we were told it will go to administration. Administrative. We call them administrative what? Expenses or administration. Administrative expenses. That is what the examiner told us. Then other than that, anything else? Let us look at whether we have any other expense that will go to the admin other than those ones which were supposed to be a portion. We look at whether we have any other admin expenses. Any other admin expenses. When we go to the trial balance, yeah, we have another one. Administrative what? Administrative staff salaries. So we have administrative staff salaries. Administrative staff salaries, we are given an amount of how much? Of 34,400. 34,400. Then other than this 34,400, what else we have? We have administrative expenses, administrative expenses, and we are given administrative expenses of how much? Again, we are given 16,800. 16,800. That is what we have. So those are the expenses which will affect the administration. The expenses which are going to affect the administration. Then from there, other than those expenses which will affect the administration, we have additional information that is talking about allowance for what? Allowance for doubtful debts. Allowance for doubtful what? Debts. 5% of what? Trade receivables. How much do we have the trade receivables? From the trial balance, go to trade receivables and trade payables. We have trade receivable of 22,800. 22,800. Therefore, our allowance for doubtful debt will be an amount of how much? Which at the end of the year is going to reduce our receivable by the same amount. So we are having 1140. 1140. 1140. Then from there, we are done with admin. Now we can go to we have selling and what? Selling and distribution expense. We have sales and distribution. Distribution expenses. Sales and distribution expenses. We are given an amount of how much from the trial balance? The last item in the trial balance, we are given 20,000. We have 20,000. That is what we are given. We have an amount of 20,000. We have an amount of 20,000. An amount of 20,000. Then I think we have not yet. I hope we haven't skipped anything. I think we have adjusted all the items as required. I'm hopeful we have adjusted all the items as required. All the items as required. All the items as required. Those are the expenses. Other than that, we have the loss on transfer. Loss on transfer, we haven't included it here, which is known as what? Manufacturing what? Manufacturing loss. We had a manufacturing loss of how much? Of 36,440. We are going to lose that amount. Then from there, let us get the profit for the year. Profit for the year. So the profit for the year will be how much? We are going to start with 83,100. Then we subtract 9,600. We subtract 8,000. We subtract 2,760. We subtract what? 2,176. We subtract 34,400. 400. Then we subtract 16,800. Then next is 1140. Next we have 20,000. And we have 36,404. So we are going to have a loss of how much? We have a loss of 48,180. A loss of 48,180. So we have a loss for the year. We have a loss for the year of 48,180. A loss for the year. We have a loss for the year of how much? A loss for the year So we have a loss for the year of that. That, hoping that we have not yet skipped anything. We have motor vehicle running expenses. Then we have electricity, rent and insurance. Then depreciation for the motor vehicle. Yeah, a half was going to the factory overhead, and therefore a half was going to this one. So therefore, let us include that. We had skipped this depreciation for the motor vehicle depreciation. So we can include it somewhere here. So we have depreciation of motor vehicle, and therefore it was an amount of 33,600. Then divide by what? Divide by 4. Then from there you divided by 2. Therefore it was giving 4,200. So therefore our answer is going to increase by that amount. So minus 4,200. Therefore we are going to get an amount of 52,380. If we had what we call, this is loss for the year, and remember it's a manufacturing account when we are talking about what? The partnership business. After getting the loss for the year, we normally go to the what we call the appropriation. Appropriation account. And how does the appropriation account looks like? We should have added what? We add interest. We add interest on what? On drawings. Interest on drawings. If we have it, then we less what? We less interest. Interest on capital. We less interest on capital. Then from there also we less salary to partners. If we have salaries to partners. Then other than that, what else? If we have a commission, then from there, since all those items were not available, we have the loss to share. The loss to share will be 52,380. So therefore, we have loss to do what? To share. The loss to share using their sharing ratio. And anytime you find that the examiner is silent about how they share, we normally share equally. With these two partners. The name of the partners were, we are talking about the two partners. The two partners were Peter Mwangi and Alois. So we talk about Peter and Alois. So they are going to get 1/2 times what? 52,380 times 52,380. Therefore, they are going to have a loss of how much? Remember, this was a loss. So we have 52,380 multiplied by 1/2. So they are going to get here 26,190, 26,190, and therefore at the end we are going to have nil. At the end we have nil. So that's how we are supposed to present our manufacturing and statement of profit or loss for the year ended that 1st December 2020. 2022. 31st December 2022. 31st December 2022. That is how we are supposed to present it. So once we have presented that, the next item is for us to present what? The statement of financial position. We want to present the statement of what? Financial position. Once we present that, the next for us to present is the statement of what? Statement of financial position. We are going to present the statement of financial position. Statement of financial position is the one that we want to present. Statement of financial position. Let us present the statement of financial position. Statement of financial position, and the name of the enterprise is Pengo Manufacturers. So we are going to have Pengo Manufacturers, Pengo Manufacturers, statement of financial position, statement of financial position as at, statement of financial position as at 31st December 2022, 31st December 2022, 31st December 2022. So we have Pengo Manufacturers statement of financial position as at that 1st December 2022. Here we have shillings in what? Our shillings were in thousands. Our shillings were in thousand. We normally start with the assets, and for the assets we have non-current assets. Non-current assets. Non-current assets. Non-current assets. We have non-current assets. Non-current assets. So therefore, let us look at the non-current assets. Again, we start from the beginning. From the beginning, we have capital, drawings, trade receivable, trade payable, bank balance, plant and machinery. So one of the non-current assets we have plant and machinery. Plant and machinery with a cost of how much? With a cost of 57,600. 57,600. Then were we given accumulated depreciation? We were not given the accumulated depreciation. So therefore the depreciation for the plant and machinery, we have it somewhere here. Depreciation, it was how much? It was 5,057.60. So we are going to subtract 57.60. So when we take that amount, how much are we gonna have? So it is going to be 57,600 minus 57.60. Therefore, we are having 51,840. 51,840. 51,840. That is what we have. Then, other than that, we continue. We want the non-current asset, another non-current asset. When we continue, we have loose tools. Loose tools. We have loose tools. Loose tools. We have loose tools. So we have loose tools. Loose tools. And for the loose tools, the information is there. We had a loose tool at the beginning, we had 16,800. Then from there, it had depreciated by how much? By 3,200. At the end of the year, we had how much? We had 13,600. Then from the loose tools, we continue. We proceed from the loose tools. We have sales. We have motor vehicle. Motor vehicle. So we go to the motor vehicles. So motor vehicles, we had 50-50. We had depreciation here of 4,200, and the other one was 4,200. So therefore, it is. We are going to take 33,600 minus what? 8,400. Therefore, how much are we going to have in this case? How much? How much are we going to have in this case? How much are we going to have in this case? So itakuwa ni 33,600 minus 8,400. Therefore, we are getting 25,200. 25,200. 25,200. That is what we have. We have an amount of 25,200. An amount of 25,200. And I think we are done with the non-current assets, so we go straight away to the current assets. Straight away to the current assets. And when we go straight away to the current assets, ya kwanza itakuwa nini? Inventory. Na inventory una copy tu. Inventory tunaanza na raw materials. Raw materials, the closing inventory of raw material, we had it here. This is an amount of how much? An amount of 15,200. Then we had the work in progress. Work in progress, we have that amount here. Work in progress, 19,440. We had 19,440. Then other than the work in progress, also we had what? We had the finished goods. Finished goods, it is here. He finished goods of what? Of 8,000. Of 8,000. That is what it makes what? The inventory. According to the International Accounting Standard 2, when we talk about the inventories, we have the inventories of raw materials, work in progress, and finished goods. Then from the inventory, we have trade what? Trade receivables. Trade receivables was an amount of how much? 22,800. 22,800. Then our receivables we reduce by 1140. So how much are we going to get? How much are we going to get in this case? 22,800. Then minus what? 1140. Then from there we are getting 21. Here we are getting 21,600 from the calculator, 660. 21,660. So other than trade receivables, we had bank balance. We had a bank balance of how much? Bank balance. We had the bank balance. Balance at bank, sorry. Balance at bank. The balance at bank from the trial balance, we had an amount of how much? An amount of how much? Balance at bank, balance at bank, balance at bank ilikuwa karibu trade receivables, that 1,400. That 1,400. We had that 1,400. Then from there, other than that, then we had the prepayment. We had the prepayment. Na hii prepayment ilikuwa ya nini? Ilikuwa ya rent and insurance. We had rent and insurance. Rent and insurance of how much? Of 7840. 7840. Then from there, we are going to get what? Total assets. We will get the total assets. Then from there, we go to the equity and liabilities. Equity and liabilities. Equity and liabilities. Then we start with what? With equity. We have equity and liabilities. We start with equity. We start with equity. And this is our equity. We are going to have what? For the equity, what I can see is the capital. So we are going to have the capital of this person known as Peter. And also we are going to have for Alois. Peter and Alois. We are going to have the capital for Peter and Alois. Peter and Alois. Then from there, we have non-current liabilities. Let me see whether we have non-current liabilities. and current liability from the trial balance, it is not visible. So therefore we go to current what? Current liabilities. So for current liabilities, the main one is the trade payables. Trade payables, tuende kwa trade receivable and trade payables. We had an amount of how much? Trade payables and receivables 28,560. So here we had 28,560. 28,560. Then other than that, what else did we have? Let us look at something else from the trial balance. Something else from the trial balance on the credit side. Tuko na sales, tuko na hiyo. Yes. So what else are we going to have? What else? Ukiangalia tu chenye kimebaki ni hii heat electricity. So we had accrued what? Accrued electricity. Electricity what? Expense. Accrued electricity expenses, which was how much? An amount of 10,400. We had 10,400. Then from there, we will get what? We are going to get the total equity. Total equity and liabilities. Total equity and liabilities. We will get the total equity and liability. So the only working we are going to have is to open the capital account. Let us have the capital account, partners capital account. Partners capital account, and we have these two. So here we need the details, and being that is a working for Peter, I'm going to present by P, and for Royce, I'm going to present by A. Then here also we need the details. Then here we have said we present by P and what? And A, alloys. So therefore we are going to start with what? We start with the balance brought down. So the balance brought down, how much were we given? The balance for the capital, 115 and 107. So we had 115,000 and 107,000. Then other than that, we had the drawings. We were given drawings of how much? The drawings were following: Peter 8,000, 6,400, 8,6,400. Then other than that, tumekuwa na nini? Tumepata loss to share. Share of loss ndio hii. Ya loss, kulikuwa na loss. Huyo alipata ngapi? 26,190, 26,190. That is what we had. Anything else? Anything else in this account? I think it is a straightforward. It is just a direct account without many items. So that is what we have. That is how we are supposed to adjust our account. This is how we are supposed to adjust our account. Let us see where our balance will be. Our balance itakuwa wapi sasa? So ni kuziongeza. Hii ni 80,000 plus 26,190. So I'm getting 106, meaning 115 ni kubwa. 115,000. So therefore the balance carried down will be 115,000 minus the answer. We have 8,810. So the capital here is 8,810. Then we go to Arois. Arois 107. So here we are going to have 107,000, 115,000, na hapa ni 107,000. So tutachukua 107,000, then we less 26,19. Just a minute. Our calculation here is not right. This I took it is supposed to be 8,000, not 80. So therefore it will be 115,000 minus what? 26, 190 minus 8,000. So here we are getting 80, 810. And here the answer is supposed to be 80, 810. Then here it is 107,000 minus 26,190 minus 6,400. So here we have 74, 410. So here also we have 74, 410. That is what we have. Then from there, we get the totals to see whether the statement of financial position is okay. So we have 51, 840 plus 13,600 plus what? 25,200 plus 15,200 plus 19,440 plus 8,000 plus 21,660 plus 31,400 plus 78,40. Therefore, we are getting 190 what? 194, 180. 194, 180. Let us see whether it is true. So it is 80, 810 plus 74, 410, then plus what? 28, 560, then from there plus 10, 400. Thank you. It is okay. We are getting 194, 180. 194, 180. That is how we do the manufacturing. That is one of the questions for the manufacturing when it comes to the manufacturing entity. So we have presented the manufacturing what? The first one was manufacturing account. The second one is the statement of profit or loss. And also we have presented the statement of financial position. That is how we are supposed to present the three financial statements. The three financial statements, that is how are supposed to be presented. So we are going to stop there. So in our next session, we are going to do another question on manufacturing. And then we summarize that topic. And then from there, we will be discussing next on cash flows. The next one will be cash flows once we summarize this. So bye-bye and have a good night.